There's a stock sitting inside the same artificial intelligence boom as NVIDIA and Palantir that almost nobody was talking about a year ago. It doesn't make chips that train AI models, and it's never mentioned in the same breath as ChatGPT or self-driving cars. It makes memory chips, the boring, unglamorous hardware that stores data. And yet this stock has gone from around $36 a share to well over $1,000 a share in about a year, an increase so large that a modest $10,000 investment at the bottom would now be worth well into six figures. So what is this company? Why did almost nobody see this coming? And is there still room left to run? Let's find out. If sleeper stock breakdowns like this are your thing, subscribe so you catch the next one before it blows up. Like this video if hidden gem stock stories help you invest smarter. And comment below which under-the-radar stock you want us to dig into next. The company is SanDisk, ticker SNDK on the NASDAQ. And here's the twist that makes this story genuinely unusual. SanDisk isn't even a new company. You've probably owned a SanDisk memory card or USB drive at some point in your life. What's new is that SanDisk only became an independent, publicly traded stock again in February of 2025, when it was spun off from Western Digital, the hard drive and storage giant that had owned the SanDisk brand for years. When a spin-off like this happens, the new stock often trades quietly in the background while investors figure out what it's actually worth. That's exactly what happened here. Right up until the moment artificial intelligence completely changed the rules of the memory chip industry. To understand why this stock has exploded, you first need to understand the boring but critical hardware category SanDisk actually competes in. SanDisk makes what's called NAND flash memory, the type of chip technology used inside solid-state drives, memory cards, USB drives, and increasingly, the massive data centers that power artificial intelligence. Think of NAND flash as the long-term storage inside a computer, the place where data actually lives even after the power is turned off, as opposed to the short-term, working memory a computer uses while it's actively running a task. For years, NAND flash was considered a commodity business, cyclical, low margin, and unglamorous. The kind of hardware business Wall Street mostly ignored in favor of flashier software and chip design companies. But here's what most investors completely missed until very recently. Training and running artificial intelligence models doesn't just require powerful processors. It requires an enormous, almost unimaginable amount of data storage. Every AI data center being built right now needs massive quantities of high-performance solid-state drives to store the training data, the model weights, and the constant flow of information these systems process. That sudden explosion in demand slammed directly into an industry that had spent the previous few years doing the opposite of expanding. This is where the story gets interesting. A few years before the AI boom accelerated, the major memory manufacturers, including Samsung, SK Hynix, and SanDisk itself, had gone through a brutal industry downturn, and in response, they cut back NAND production significantly and shifted manufacturing capacity toward other types of memory chips instead. Then, almost overnight, AI data center demand exploded, and there simply wasn't enough NAND flash supply left in the world to meet it. Research firm Gartner has projected NAND flash memory prices could rise by more than 200% in a single year because of this supply and demand imbalance. And industry analysts don't expect the shortage to fully resolve until sometime around 2028. When you have surging demand crashing into a supply shortage that took years to create, prices don't just rise, they spike. And that spike went straight to SanDisk's bottom line. Before we get to the numbers, it's worth understanding a little more about what SanDisk actually sells, because this isn't the company doing just one thing. Its product lineup spans the full spectrum of flash storage, from consumer memory cards and USB drives that most people grew up using, to embedded storage chips that go inside smartphones and laptops, all the way up to the massive, high-performance, solid-state drives that data centers buy by the thousands. That range matters, because it means SanDisk isn't purely a bet on one narrow slice of the AI story. It's exposed to consumer electronics, enterprise computing, and AI infrastructure all at once. Historically, that diversification made SanDisk's results choppy and hard to predict, since consumer demand and enterprise demand don't always move together. Right now, though, nearly every one of those categories is being lifted by the same underlying force, a global shortage of flash memory that's pushing prices higher across every product line the company sells. It also helps to understand who's steering this business. CEO David Goeckeler, who previously led Western Digital before the spin-off and spent years running a major networking technology division earlier in his career, has been candid that memory has always been a brutally cyclical industry, and equally candid that the new long-term contracts SanDisk is signing represent a genuine attempt to change that. Investors tend to respond well when a management team openly acknowledges the risks of its own industry, while still making a clear, structural bet to fix it. And that's part of why Wall Street's tone toward this stock has shifted so quickly this year. Let's get into the actual numbers, because they are some of the most dramatic financial results you'll see from any established company this year. In its fiscal third quarter of 2026, covering the 3 months ending in early April, SanDisk reported revenue of just under $6 billion, up 251% compared to the same quarter the year before, and up an extraordinary 97% from the previous quarter alone. To put that in perspective, most companies consider 20 or 30% quarterly growth to be exceptional. SanDisk nearly doubled its revenue in a single quarter, sequentially, not even year over year. But here's the number that changes everything about how investors think of this company. Non-GAAP gross margin jumped from around 51% the prior quarter to 78.4%, a level almost unheard of for what used to be considered a low-margin commodity hardware business. Adjusted earnings per share flipped from a loss of 30 cents per share a year earlier to a profit of $23.41 per share, blowing past the company's own guidance of $12 to $14. When a company doesn't just beat expectations, but nearly doubles its own forecast, that tells you the underlying demand and pricing environment shifted even faster than the people running the business anticipated. Management didn't slow down after that. Guidance for the following quarter called for revenue between $7.7 and $8.2 billion, with gross margins expected to stay in the range of 79 to 81%. This is a business now generating profit margins that rival some of the best software companies in the market, despite technically being a hardware manufacturer. So why should you believe this isn't just a temporary spike that reverses the moment supply catches up? This is exactly where things become interesting, because SanDisk's management has been trying to answer that exact question, and their answer involves something the NAND flash industry has never really done before. The company has started signing what it calls new business models, essentially long-term supply contracts with major customers that lock in committed volumes over multiple years, some backed by financial guarantees from third-party institutions. If a customer fails to purchase the volume they committed to, the guarantee triggers financial penalties immediately. As of the most recent quarter, SanDisk had built a contracted backlog reportedly worth around $42 billion. Management has explicitly said the goal of these contracts is to reduce the brutal boom and bust cyclicality that has defined the memory chip industry for decades. If this strategy works as intended, SanDisk wouldn't just be riding a temporary price spike. It would be permanently repricing its own earnings power around a more stable, contracted revenue base. Now, before you get too excited, this is exactly where we need to slow down and talk honestly about the risks, because this is one of the most important parts of the entire SanDisk story. The single biggest risk is the one word every long-term NAND flash investor already knows intimately: cyclicality. This industry has a long, well-documented history of massive price swings, and previous attempts at long-term pricing agreements in the memory business have broken down before during past downturns when spot prices moved dramatically. SanDisk's own new contracts include variable pricing components on their longer-dated portions, meaning if the industry responds to today's shortage by building enough new capacity and spot prices fall significantly, some of SanDisk's locked-in advantage could erode faster than the backlog numbers suggest on paper. The second major risk is competition. Samsung and SK Hynix, two of the largest memory manufacturers in the world, are watching the exact same pricing environment SanDisk is benefiting from, and they have both the capital and the manufacturing expertise to ramp up NAND production if they choose to chase these same profits. A faster than expected supply response from these competitors could cool down the pricing dynamics that have driven SanDisk stock higher this year. The third risk, and this is the one that matters most for anyone considering buying the stock today rather than a year ago, is valuation and volatility after an enormous run. Even after pulling back meaningfully from an all-time high above $2,100 a share, SanDisk still trades with a market capitalization near $290 billion. The stock has already experienced sharp, fast pullbacks this year, including drops of close to 10% in single trading sessions tied to broader sector rotation out of chip stocks and concerns that the memory boom has become overheated. This is what Wall Street isn't talking about enough when the headlines only focus on the incredible year-to-date gains. A stock that can rise several 100% in a matter of months can also give back a significant portion of those gains just as quickly if sentiment shifts. There's also a structural risk worth mentioning briefly. Because SanDisk was only recently spun off from Western Digital, large blocks of shares held by early insiders and the parent company have been subject to lockup periods. And as those restrictions expire, the resulting wave of shares becoming available for sale has already caused temporary pressure on the stock price in the past. This is the technical risk rather than a fundamental one, but it's part of the reason this stock can be more volatile than a company with a longer trading history. So what does Wall Street actually think about all of this? The analyst community has grown dramatically more bullish over the past few months. Of the analysts currently covering SanDisk, the overwhelming majority rate the stock a strong buy, a meaningful upgrade from a more cautious, moderate buy consensus just a few months earlier. Bernstein, one of the more prominent voices covering the stock, has set a price target as high as $1,700, describing the most recent quarter as a decisive beat, backed by genuinely strong underlying demand rather than temporary noise. At the same time, a handful of analysts remain on the sidelines with hold ratings, generally citing the same cyclicality and valuation concerns we just walked through. When a stock has already risen this much, this fast, even bullish analysts tend to build some caution into their targets. It's also worth putting SanDisk's move in context alongside the rest of the memory chip industry, because this isn't a story happening in isolation. Micron Technology, one of SanDisk's closest competitors in the broader memory space, has also posted blowout results recently, driven by the exact same AI-fueled demand for high-performance storage and memory. When a rival reports similarly strong numbers around the same time, it tends to confirm that what's happening at SanDisk is an industry-wide shift in demand and pricing, not a one-off fluke specific to a single company's execution. At the same time, that also means SanDisk's fortunes are tied to broader semiconductor sector sentiment. And when investors get nervous about chip stocks as a group, even a company executing well can get pulled down alongside its peers. We've already seen glimpses of that this year, with SanDisk shares sliding on days when the entire chip sector rotated out of favor, even without any company-specific bad news. Let's talk valuation directly, because the picture here is genuinely more nuanced than the eye-popping percentage gains suggest. SanDisk currently trades at a price-to-earnings ratio in the neighborhood of 70 times trailing earnings. On the surface, that sounds expensive, similar to some of the priciest software companies in the market. But remember, this business just multiplied its earnings power several times over in the span of a couple of quarters. And if the current pricing environment and new contract structure hold up even partially over the next year, that same 70 times multiple could look considerably cheaper once forward earnings catch up to where the stock price already sits. This is precisely the kind of situation where traditional valuation metrics become tricky. Because you're not just betting on today's numbers, you're betting on whether today's numbers represent a temporary spike or a new, more permanent baseline for the business. So where does that leave us for a final verdict? SanDisk's recent financial results are genuinely extraordinary, and the company's attempt to build long-term contracts around a historically cyclical business is a legitimately interesting strategic shift that could change how investors value the entire NAND flash industry going forward. But this is also a stock that has already made an enormous move, sits in a historically volatile industry, and depends heavily on a supply and demand imbalance that competitors are actively working to close. Given all of that, SanDisk currently sits closest to a hold for investors who've already captured some of this run and want to protect their gains, and a speculative buy only for growth-focused investors who understand memory chip cyclicality, have a high tolerance for volatility, and believe the new contract-based business model will genuinely hold up through the next industry cycle. Looking 3 to 5 years down the road, the long-term outlook for SanDisk comes down to one central question that nobody, not even the company's own management, can answer with total certainty yet. Can these new long-term supply contracts actually survive a real industry downturn, the way they're designed to? Or will SanDisk eventually face the same boom and bust reality that has defined memory chip stocks for decades before it? If AI data center demand continues expanding at anything close to its current pace through 2028, and competitors don't flood the market with new supply too quickly, SanDisk could genuinely emerge from this cycle as a fundamentally different, more stable business than the one investors used to associate with commodity memory chips. If the shortage resolves faster than expected, or a global economic slowdown reduces data center spending, this stock could give back a considerable portion of this year's gains just as fast as it earned them. So let's bring this all together. SanDisk is proof that some of the biggest winners of the artificial intelligence boom aren't the companies building flashy AI products at all. They're the unglamorous hardware businesses quietly supplying the infrastructure underneath the entire industry. This stock's rise from around $36 to well over $1,000 in roughly a year is one of the most dramatic moves in the entire market this year. But dramatic moves cut both directions, and the same volatility that created this opportunity can just as easily reverse it. Remember, great investing isn't about chasing hype. It's about making informed decisions. If this breakdown helped you discover a stock you hadn't considered before, hit subscribe so you don't miss the next hidden gem we cover. Like this video if sleeper stock stories like this are useful to you, and comment below which under-the-radar stock you want us to analyze next. Don't forget to turn on notifications so you never miss an upload. Thanks for watching, and we'll see you in the next one.